Thank you for your interest today. If you're viewing this video, it's highly likely that you haven't viewed any of the other videos in our library of videos on tax-deferred exchanges. This would probably be the first video that our staff would suggest that you view based upon what we call the biggest misunderstanding in the area of tax-deferred exchanges. By now, you've probably spoken with possibly me or other staff members in our company, and they've helped you evaluate whether or not a tax-deferred exchange will make sense for you. The difficulty out there today, and it's prompted a bit by some of the articles out on the internet, is that many parties out there today believe that a tax-deferred exchange is a profit exchange, or a tax-deferred exchange is merely reinvesting the profit dollars in another property, and you're able to get the dollars back that you originally invested in your original investment that's being sold in the transaction. If we were to look today over the years of our history and were to, let's pretend I was David Letterman and I was coming up with the top 10 areas of questions and misunderstandings in tax-deferred exchanges, this would be definitely number 1 or 2 in the area of tax-deferred exchanges, because many parties believe that one can exchange just the profit that occurs from their overall investment, when in reality we need to talk about exchanges as being value exchanges, where we are exchanging the full value. The question comes up, of course, is where the exchange or a client such as yourself has acquired what we call a low basis property. Let's hypothetically say that we have a property that is worth $1 million today that was acquired for $100,000 at a time in the past. And of course, that's about a $900,000 appreciation of the property, and not even talking about the adjustments that would be made for depreciation and those types of things. So that's what we call a low basis, high value property. And of course, the exchanger would certainly like to get their original investment back and possibly exchange the rest or do some other combination thereof. But in reality, what occurs is these are called value exchanges, and we need to exchange the full value of the property that we're selling, we call it relinquishing, in order to acquire a replacement property, that property which replaces that which we got rid of. And in order to have 100% tax-deferred exchange, we need to acquire a property that has equal what we call exchange value. In one of our other videos, we'll spend a good time talking about exchange value. But to refresh your memory, if you viewed that video, or to give you an understanding of what exchange value means, if you haven't, exchange value is pretty simple. It's the sale price of the property that you're relinquishing, less attributable sale costs, commissions, title fees, escrow charges, recording charges, seller concessions to buyer closing costs, qualified intermediary fees. All of these normal everyday closing charges are attributable to your transaction and are subtracted from the sale price to determine the exchange value, or in essence, the value that would be used for capital gains tax analysis. In many cases, if you have a residential property and you've got a broker involved, and you're possibly in the state of Washington, you may have as much as 9 or 10% actual attributable closing costs. If you're in California, the number will be different. If you're in Idaho, the number will be different. If you're in New York, the number will be different, because it all depends upon a variety of factors, and commissions and all these other factors come into play. We can help, we can assist. Whenever you give us a particular transaction, we can help you calculate the exchange value. But for purposes of our video today, exchange value is not the sale price. It's the sale price minus the normal closing costs. But you'll notice I never mentioned anything about mortgages. If you have a mortgage to pay off, a mortgage payoff is not a closing cost. It's a payoff of a mortgage that lessens the amount of cash that we have, but it's not an actual closing cost. So as we're moving forward in the exchange arena, let's imagine for just a moment that you have an investment property. The investment property has been held for a goodly number of years. The investment property is in a different state, hypothetically, that state. And let's pretend that you wish to have this particular property moved to the state of Washington. So you're moving from California and you're moving to the state of Washington, and you'd rather not have your investment property down in California remain there. Maybe there's a variety of factors. The ability to manage the property, or the fact that the property is in an area that's not as favorable as it was in the past. We have a lot of reasons why you'd like to do a tax-deferred exchange. Unfortunately, we can't move the dirt from California up to Washington. The dirt's going to remain there, but we can do a tax-deferred exchange from that investment property in California all the way to Washington or any other state, including Alaska, Hawaii, and some of the protectorates. We can do an exchange of that overall value. So let's pretend that the value of the property is $1 million. Let's pretend that the costs of selling the property are $100,000. Your exchange value is $900,000. In order to complete a 100% tax-deferred exchange, we need to acquire a property, but not necessarily one. We can acquire 2 or 3 or 4 that equal $900,000. An important point. Probably the 4th or 5th huge misunderstanding out in the marketplace, and you'll hear this from real estate agents and brokers and accountants and a variety of people. They will say that you must complete a transaction in which you acquire property equal to or greater than the overall value of the property that you exchanged out of, and that is wrong. You can complete a less than 100% tax-deferred exchange. If you do, it's still legal, it's still appropriate, there's nothing wrong with it. You will pay capital gains tax on that amount of dollars over and above the exchange value that you didn't exchange. So if you do a $800,000 tax-deferred exchange acquiring an $800,000 property, and you had a $900,000 relinquished property, you're still completing a very valid tax-deferred exchange, but you're not doing 100%. You're doing less than 100%, which means you'll pay capital gains tax on the profit portion of that difference between $800,000 and $900,000. It's important to understand that you don't have to complete a tax-deferred exchange of equal value. There is a point of diminishing returns, and that's a point that you may want to contact our office. If all of a sudden you're not planning on completing anything greater than a 60% tax-deferred exchange, I would suggest that you call our office and have us do a calculation, because there is a point of diminishing returns. And that point of diminishing returns is what we call the adjusted value of your property. So if the property was acquired for $100,000 and you've taken depreciation, the point of diminishing returns is typically that adjusted basis amount. As you're looking at doing a tax-deferred exchange, we have to talk about 3 components. Most of our exchange clients that do exchanges with us will have a mortgage on their property that they're relinquishing. So in order to complete a 100% tax-deferred exchange, we're going to have 3 rules. In one of our other videos, we talk about these 3 rules, so you may hear it again if you look at one of our other videos. But the first rule is, in order to complete a 100% tax-deferred exchange, we need to acquire a property, but keep in mind that could be more than one property. It could be any number of properties that equal or exceed the exchange value of the property or properties that you're relinquishing. Again, if the exchange value is $100,000, in order to complete a 100% tax-deferred exchange, we must acquire a replacement property or properties worth $100,000. What happens if we don't? We're doing a partial tax-deferred exchange. As we said before, we're going to pay capital gains tax on that value that we didn't acquire. We still have a valid exchange, we're just going to pay a portion of capital gains tax. Rule number 2, we need to acquire debt equal to or greater than the debt relieved on our relinquished property. So if we have $50,000 of debt on our relinquished property, then we need to acquire at least $50,000 of debt on our new property. Oh, by the way, you can replace that debt with your own cash. Keep that in mind, you can always do that, but we need to replace the debt as well. Rule number 3, we need to use all cash that comes from the closing of our relinquished property in order to acquire the replacement property or properties. If we meet all 3 rules, we will have completed a 100% tax-deferred exchange. If we don't meet all 3 rules, we will have completed a valid tax-deferred exchange, except it won't be 100%. We're going to pay a portion of that capital gains tax attributable to that portion of the transaction for which we did not do a tax-deferred exchange. In conclusion, the key thing we want to have you take away from this video is to understand that these are value exchanges, not profit exchanges, not equity exchanges, none of the things that you may be thinking about. They are full value exchanges. And the other takeaway is that you don't have to complete a 100% tax-deferred exchange. You can complete an exchange at less than full 100% and still have a valid tax-deferred exchange. As usual, we're more than happy to answer any questions that you may have. This, along with other videos, is intended to help and assist you in answering those questions. They don't answer every question. We have staff available in our office out of Tacoma that can answer your questions. Our nationwide toll-free number is 1-800-236-4948. Our local number is 253-383-1200. And we welcome your call to answer your specific questions regarding tax-deferred exchanges. Thank you.